every single remote worker in America is staring at their tax return right now, wondering the same thing: is this home office deduction actually worth it? Or am I basically mailing the IRS an invitation to ruin my year? Because the answer is not what your coworker told you in the Slack channel. And it's definitely not what that viral TikTok accountant made it sound like. Let's set the stage. Since 2020, tens of millions of Americans started working from home. And suddenly everyone and their golden retriever thought they qualified for the home office deduction. The IRS watched that trend like a hawk circling a very suspicious parking lot. Here's the uncomfortable truth that nobody in the personal finance space wants to say out loud. If you are a W-2 employee, meaning your employer issues your paycheck and withholds taxes, you cannot claim the home office deduction under current law. The Tax Cuts and Jobs Act of 2017 wiped out unreimbursed employee business expenses through at least 2025. So if you're punching a virtual clock for someone else's company, that deduction is simply not available to you, no matter how perfect your dedicated workspace is. Now, if you're self-employed, a freelancer, a sole proprietor, or running a side business, that's a completely different conversation. And suddenly the deduction becomes very real and very valuable. Think of it like a VIP section at a concert. W-2 employees are stuck outside in the rain, but the self-employed crowd gets a wristband and access to something genuinely useful. The misconception here is enormous and has been fueled by 3 years of remote work culture, making everyone feel like they deserve a tax break just for owning a desk lamp. Millions of people have filed deductions they were never legally entitled to, and the IRS has absolutely noticed. So what does the audit risk actually look like in practice? The IRS audits less than 1% of individual returns overall. But home office claims, especially large or disproportionate ones, are a known red flag that can pull your return into closer scrutiny. The deduction requires that your space be used regularly and exclusively for business, meaning your kitchen table where you also eat tacos on Tuesday nights does not count, no matter how many Zoom calls you've taken from that chair. Exclusivity is the word that kills more home office claims than anything else. And it is the part that most people quietly fudge without realizing the legal exposure they're creating. Historically, the home office deduction has had a complicated reputation in the 1980s and 90s. It was so widely abused that Congress tightened the rules dramatically, and the IRS developed a reputation for treating the claim as a near automatic audit trigger. That reputation has softened somewhat with better documentation tools and the simplified method introduced in 2013, which lets you deduct $5 per square foot up to 300 square feet, capping out at $1,500 without requiring you to track actual expenses. The simplified method is genuinely underutilized and underappreciated. It lowers your audit risk by removing the complex calculations that tend to draw scrutiny. And for many small home offices, it captures most of the benefit anyway. Think of it as ordering off the prefix menu instead of trying to customize every single item, less impressive on paper, but far less likely to end in a scene. If you are legitimately self-employed and you do have a dedicated exclusive workspace, the deduction is absolutely worth taking because you are legally entitled to it, and leaving money on the table helps nobody. The key is documentation. Photograph the space, measure it, keep records of your business income tied to that address, and make sure the numbers are proportionate and defensible. The broader lesson from every tax cycle we've watched play out is that the people who get hurt are not the ones who take legitimate deductions. They're the ones who take wishful deductions and then panic when questioned. Discipline in tax strategy, just like in investing, means only claiming what you can rationally explain and defend with paperwork at 2 p.m. on a Tuesday when an IRS agent is on the phone. The irony of the remote work era is that the people who most feel like they deserve a home office deduction, the W-2 employees who converted their spare bedrooms and bought standing desks and ergonomic chairs, precisely the people the law excludes. Meanwhile, the freelancer working from a closet with a folding table is the one legally entitled to write it all off. At its core, this whole situation is a story about the gap between how we feel and what the law actually says. And closing that gap requires about 20 minutes of honest research rather than vibes and forum posts. Rational preparation beats conviction every single time. And knowing your actual eligibility before you file is worth infinitely more than the deduction itself. So the answer to whether the home office deduction is worth the audit risk is simple. If you qualify, yes, Document it and take it without guilt or hesitation. If you don't qualify, the risk is infinite because you'd be claiming something you were never owed in the first place. And if you're thinking about ways to build real financial leverage through real estate, contracting projects, or smart lending, check out our links in the description below, where we can help you get started on all of it.